Hello, very good morning to all. Welcome back again. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Welcome to today's Daily Dose of Market Insights. Today will be Wednesday, the 20th of March, 2024. So before we start our Daily Dose of Market Insights, as usual, the disclaimers first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now, as usual, let's us take a look at what has taken shape yesterday in terms of the performance of the broad-based cross-asset classes, ranging from the major FX, the major stock indices, commodities that we'll be covering two major commodities, which is gold, spot gold XAU/USD, and West Texas oil, WTI crude. And most importantly, what events or economic data that has a indirect or direct impact on this movement on the broad-based cross-asset classes. And as well, lastly, today will be sum up with the short-term technical outlook on these various broad-based cross-asset classes. So yesterday's big event was Bank of Japan. So Bank of Japan, we in expectation, they didn't actually surprise the market in terms of two things. One, they actually hiked interest rates to 0%. It's a range between 0% to positive 0.1%. That means, i.e., they totally remove of their short-term negative interest rate policy, and as well as scrapping off the yield curve control. All right, but what's actually surprised the market is that they actually maintain a shadow residual quantitative easing. So what do I mean by this? Okay, so if you look at my screen over here, okay, let me share with you what do I mean by this. So okay, where is it? Yeah, over here. Good. Okay, so if you look at my screen, right, this I obtained it from a reference page of Bank of Japan. So you can actually go to Bank of Japan. Every now and then they actually come out once the release of a new monetary policy decision, they will actually release accompanying charts to actually telegraph to the market what are they saying. So what you could see, this is the changes in monetary policy framework out yesterday. So what they did over here is that they did mention that it considered its large-scale easing measures have fulfilled their roles. That means, i.e., no longer having this short-term negative interest policy and a total scrap of that yield curve control. Okay, so what is yield curve control? Yield curve control, for those who recall, in my previous daily dose, or for those who are familiar with Bank of Japan monetary policy, is that they kept the 10-year JGB yield at a fixed percent, both on the upper limit and the lower limit. Previously, they have this at 0.5%. Then thereafter, it slowly push up the upper limit to 0.75 and to 1%. And the last adjustment was during the October meeting last year. They used that 1% level as a reference rate rather than the hard cap. So previously, right, what they did is that every time the 10-year JGB yield come close to this upper limit of this 10-year JGB yield, they will actually, Bank of Japan will come in and intervene and buy JGB bonds, the 10-year JGB bonds, to push down the 10-year. All right, so they actually have a kind of a quantitative easing, prevent higher long-term interest rate in Japan to actually shoot up on the upside. All right, so that was their concern then in the last 1 year or so, given that we know that inflationary pressure globally has started to inch higher. So, but what it means that, interestingly, right, if you look at this diagram on my right, on your right side, this is a long-term interest rates. So previously there is this reference rate of 1%. Okay, they keep it a reference at 1%, not hard cap, reference 1%. That means, i.e., they could allow it to actually deviate up slightly above 1% before they decide to come in. That means they want to surprise speculators on the JGB futures market, all right, by not having a hard cap 1%. And right now, what's confusing after the market participant is that, yes, they want to scrap off. They say that it's no longer a large-scale monetary policy easing measure has fulfilled their roles. That means they will scrap up the yield curve control. So they do not have this 1% as a reference limit anymore, but they actually put a footnote saying that in case of a rapid rise in long-term interest rate, the Bank of Japan will make nimble response. Okay, what is this nimble response? Nobody knows. Such as increasing the amount of JGB purchase. How much they want to increase during the press conference of Bank of Japan, Yuda, he also did mention very clearly as well. And most importantly, highlighted in bold over here is that the Bank of Japan will continue its JG purchase broadly the same amount as before. So what it means that despite the scrapping off of the yield curve control YCC, they have some form of residual, I'll put that, shadow quantitative easing measure vibes in place. That means they said that they tell to the market participant, hey guys, we are still looking to buy JGB bonds, despite we are scrapping off the 10-year JGB yield, the scrap of the yield curve control. So what are you telling me? So yes, you're telling me that you remove the YCC, yield curve control, but on the other hand, you will nimbly respond to a rapid rise in long-term interest rate. So there is still some form of quantitative easing, I will use the word shadow quantitative easing that is still in place for the BOJ monetary policy framework at this juncture. All right. So with that, right, because of this shadow quantitative easing in place, it allows the dollar yen to spike up above our short-term pivotal resistance yesterday at around this 49.50 level, which is the 20-day moving average, that saw some form of selling off at the start of this. So once market participants digest this diagram, right, they start to feel that, hey, BOJ seems to be not so forceful in implementing its normalization, we call it normalization of its ultra accommodative monetary policy. Okay, because of having this some form of shadow quantitative easing that's still in place. So what happened over here is that you look at the 10-year JGB, not 10-year JGB, the dollar yen rate. So the dollar yen was actually the outlier yesterday. So what I could see is the 5-day rolling performance as of now. The dollar yen spiking up to positive 2.4% as we are speaking right now, whereas the rest of other major pair like the euro, the CAD, the sterling, all remains trading sideways against the dollar. So even the dollar Aussie also came to fare off a bit as well during today's Asia session, followed by the Kiwi. That means what we could see over here, the only strong outlier in terms of dollar strength only against the Japanese yen at this juncture. All right, so later I'll touch on more on the technical chart of the dollar yen because it's hovering very close to a key major resistance level. So that's for the FX market. So over at the stock index market over here, the major US stock indices continue to be very positive yesterday. So if you look at the S&P heat map, all of them almost in the green. And the one that is driving the gains are, as usual, the magnificent 7 mega cap stocks, especially on Apple, Microsoft, and Nvidia, going to actually soar to 1% after I think the last 1 or 2 days of losses. So why Nvidia actually going to actually spurt the market over here is due to AI optimism again ahead of the Federal Reserve meeting today. So what we see that Nvidia actually made a slew of announcement over here. They actually announced a new generation of artificial intelligence chips and software for running AI models. So this was actually part of their so-called, the conference, NVIDIA specific conference. So they announced in public that more AI related products. So that's kind of give a bit of optimism to the market. So, but however, the Nasdaq 100, yeah, even though if you look at the performance of the broad-based index, over here, the US broad-based index, the S&P managed to gain positive 0.56%, but unfortunately, the Nasdaq 100 actually underperformed, only positive 0.26%, and it failed to actually break above the 18,110 resistance level that we highlighted yesterday. So the top performer is the Dow Jones Industrial Average, up 0.8%, and the Russell up 0.5%. All right, and also another positive news flow out in terms of economic data out from the Eurozone is the all-important anchor of Eurozone, which is Germany. So Germany yesterday released their one of the consumer sentiment index. They call it the ZEW Consumer Sentiment Index. It actually surpassed market expectation. Market is only expecting 20.5. It surpassed to 31.7, above 19.9 in the previous month of February. So if you look at the trend of this economic sentiment in Germany over here, okay, it rose to 8 for the 8 consecutive months to the 31.7 in March. So this is the highest level since February 2022. All right. So if you look at the trend over here, previously there was actually very disaster. So if you look at the 5-year trend, it's very clearly shaping a higher high and a higher low. Okay, and if you do some technical analysis, it broke this previous lower higher, break of the resistance. So that actually also supports the ongoing bullish trend of the German DAX. So those were actually highlighted, follow our market dose of market the daily dose of market insights. So German DAX, we have been consecutively have a bullish bias tone since about 3 to 4 weeks ago, and we keep tightening up the short-term pivotal support at 17,900 yesterday. So that's the reason why the German index remains in a short-term to medium-term uptrend because of the ongoing improvement in leading fundamentals data. So economic sentiment data is considered as a leading economic data. All right. So that's for now for the Eurozone side of the story. So other than that, what do we have in terms of economic data releases so far today? So far today, what we could see is early this morning, during the Asia session, before we speak at 9:15 a.m. Singapore time, we expectation no change. The China PBoC central bank remains, this is their another benchmark interest rate, because China, they do have a couple of benchmark interest rates. It's not like the Fed or BOJ or Eurozone or ECB. They'll say one policy rate. In China, they have 3 to 4 policy rate. All right. So this is the second and third policy rate. The loan prime rate, which is the 1-year rate, that is more or less tied to mortgages, and the loan prime rate 5-year is tied to like a business loan and consumer loan. So they actually keep it no change at 3.45% and 3.95% respectively. Okay, so what we could see over here is that the China top policymakers, their mindset is that they keep telling market participants, hey, we are not like in the past, like 2015 or during the great financial crisis in 2009 to 2008, 2009. Yes, we know that China itself is, the economy is weakening. We know that there is ongoing rivalry between us and US, but we are in no need and there's no reason for us to unite, we call it we call it abundance liquidity into the Chinese economy. So what they are actually trying to tell us that they are still in favor of piecemeal fiscal and monetary policy stimulus. All right, so that actually should actually potentially put in a way that cap any form of major bullish basing formation in the China stock market as well as the Hang Seng Index. So whatever price action that we see in the Hang Seng Index right now, or even some of the China benchmark stock indices, more or less this is something like form like a counter trend rebound scenario within their long-term downtrend phases that is still intact. Okay, so that is the economic data that has taken shape yesterday and this morning. So what we could actually highlight over here, let us talk about what we're going to focus today as well, before I jump straight into the short-term technical outlook, because today is pretty much key. We have several economic data to digest. So at 3 p.m. Singapore time, we do have the UK inflation data. So the core inflation data continue, market expecting continue to decelerate to 4.6% from 5.1% year on year in the month of January. So something to look out for. And most important, after that, we do have some ECB officials speaking. 4:45 p.m. we have ECB President Lagarde speaking, followed by another one of her officials, ECB Land, speaking at 5:30 p.m. Singapore time. And all the way, US actually will be much quiet until we have 2 a.m. Singapore time, where the Fed will release their interest rate decision, and most important, the dot plot projection. Okay, so this dot plot projection is very important. Why? Because in the previous, because they don't release every month, they only release every 3 months. Okay, so this is a March 3rd month release. The last release was in December. So to recap, in December, the Fed starts to turn much more boldly dovish, and starts to pencil in at least 3 interest rate cuts for 2024. Okay, that was then in December, and throughout January, February, until today, after we start to see more economic data out from US, especially the CPI data out from US, be it the CPI or the PCE data, these numbers are not showing as soft as what the market is expecting and as what the Federal Reserve is expecting. So based on their latest guidance by Fed Speak, most of the officials, including Fed Chair Powell, are actually more in favor of not hiring to actually cut interest rates. So that's actually reduced market expectation at the start of this year from 6 interest rate cuts to only 3 interest rate cuts as of now, based on the CME Fed Watch 2. So if you look at the CME Fed Watch 2 over here, I will share my screen. So where do we are? Okay, so we go to CME Fed Watch 2. Okay, so you look at CME Fed Watch 2, more or less this meeting, there will be no interest rate cut as being projected by the slew of Fed Speak and latest economic data, unless the Fed really want to surprise us with a cut. Then the stock market could rally very heavily, because 99% chance no cut at 5.25% and 5.5%. That is the current Fed fund rates. All right, so okay, at this juncture. Okay, so if you look at May as well, there'll be no cut in May as well, 96.2%. The first cut will come in June. Okay, so that's around 60%. Okay, almost in line with a week ago and a month ago at 55%. So no change in the expectation so far. So now the big key thing is that this will only change when the Fed starts to, when the market participants starts to actually digest the latest dot plot. So the biggest risk over here is for those Fed pivot, Fed dovish pivot narrative to actually get reduced in probability. Is the Fed starts to reduce, instead of penciling 3 interest rate cut for this year, they start to reduce to 2. So that could be sounded as a very slight skew towards the hawkish side of the story. So that could actually potentially reduce the expectation of interest rate cuts as being priced in by the Fed Fund futures as concluded by the CME Fed Watch 2. So that potentially could also see a spike up in the US 10-year Treasury yield and a potential, we call it sell-off in the major benchmark US indices. So pretty much volatile today. So if you look at the total probability, before we go to the economic calendar again, so you look at the way how we calculate the total probabilities by looking at this. So from this, right, the CME Fed Watch 2, they actually, if you look at the one in light, the box in light blue over here, and you go all the way down, okay, diagonally. So as it's slowly to move one step down, so as you see over here, no cut, right, 99%, 96%, no cut. So the next one, there will be 60% chance of a cut. Then thereafter, there will be no cut because it pushed down horizontally. Then vertically, again, the next one, 43% of another cut to 4.75% to 5%. So there's 1, 2, no cut as well over here, then followed by another one at 34.9% cut in the last meeting of 2024. So total, there will be only 1, 2, 3 interest rate cuts that's being priced in by the CME Fed Watch 2 for 2024, based on what is market is expecting on the Fed to do. All right, but provided that all this could change again, if the Fed starts to surprise us by skewing towards a more hawkish tilt, that means, i.e., instead of penciling 3 interest rate cuts for 2024, they start to only do 2 interest rate cuts, and they start to cite that perhaps inflationary expectation continues to remains high. All right, why? Because if you look at, there's a risk, because this chart I will share with you again over here. I think I shared with this yesterday. Yeah, this is the inflationary expectation by looking at the traded US 10-year, 5-year break even and 10-year break even. So 5-year and 10-year break even, think it as a tradable form of market pricing in of future inflation in US 5-year from today and 10-year from today. And you look at the break even rates are actually inching upwards in line with WTI crude oil price. And those who actually follow our daily dose of market insights, I did highlight that after the breakout of the WTI crude oil price at $78.50 per barrel, potentially we may start to slowly inch up higher to 83.90, then thereafter follow up to 90 level as well. So if oil price is going to go up from here, it doesn't bode well for future inflation expectation in US. So that could be also one of the reasons the Fed is watching to actually tone down their Fed dovish pivot that they narrate to the market at the end of last year. So something to keep an eye watch for, especially why? Because other than that, during Powell press conference, whether Powell press conference mentioned this heightening of this inflationary expectation. So if you look at it over here, the calendar again, all right. So after 2:30 a.m. Singapore time, this is where Fed Powell will be speaking as well. So this also will be another risk event to actually take note of. All right, so this is the key economic data event calendar that I want to highlight to you all. All right, so now let's now jump straight to the short-term technical outlook. Right, so let's start with the intermarket relationship first between the 10-year US Treasury yield and how does it impact of the market. So if you look at the 10-year US Treasury yield, going to be remain sideways. So over here, right, if you look at the 10-year US Treasury, still refused to break above the lower limit of this major resistance zone at 4.33% / 4.5%, but still holding above the 50-day, not 50-day, the 200-day moving average over here, I think as a support right now at around, what's this level? Okay, 4.2%. All right, 4.2%. Okay, then definitely the next support level to watch will be 4.06%. So that was the low on 8th of March. Okay, tested previously on the 7th of March. So what's interesting over here is that yesterday's we call it rejection of the 4.33% comes with a bearish engulfing candlestick formation. So it could be a very messy kind of, if prices start to come down again but didn't break the 200-day moving average, so it will be evolving in a sideways range configuration rather than pushing all the way down, unless it could break down below 4.06%. All right, so it'd be more like a range bound configuration in terms of the 10-year Treasury yield. So going forward, right, if this range bound configuration continues out to play out in the next couple of weeks, right, so what we could see over here is a very kind of unclear messaging that the Fed will try to transpire to the market. That means, i.e., they want to cut rates, but they tell the market, hey, we will be not so aggressive as usual. We are more data dependent. So I believe that they try to transpire this message to the market as well, because they can't be too hawkish, right? Because if you get too hawkish, there'll be a problem, because this will get a bit more political, given the fact that this is an election year where, you know, indirectly the candidates from the Democrat and the Republican do not want to see a severe correction in the US stock market, which is the benchmark stock market. So the only way the benchmark stock market may actually collapse is due to the US 10-year Treasury yield keeps spiking up above 4.5%. If it start to break above this major resistance level, it could retest that previous swing high in 23rd of October again, right? So that could be the potential trajectory of the US 10-year Treasury yield, and how does it impact the market that I shared with you earlier on. So given the fact that the US 10-year Treasury yield is remaining capped at 4.33% yesterday, the US dollar going to pierce up instead above the 20-day, the 200-day, and the 50-day moving average, which was previously acting as resistance at around 103.70. So this pierce up over here, right? Because see how the price goes after today. All right, because this little push up here is only driven by the dollar yen. So why dollar yen? For sure, if you look at my earlier chart, right, that I shared with you earlier, okay, by the 5-day rolling performance, right, this is the only outlier of the dollar yen that is pushing up. The rest of the major currency, right, even the dollar Swiss, the CAD, the sterling, the euro, all remains continue sideways, and even dollar strength also starts to dissipate in the Aussie and the Kiwi from a short-term basis. This is a 5-day rolling performance chart, okay, where I plotted dollar against the rest. Okay, so something to pay attention to for the dollar index, right? So perhaps this is just a failure breakout, given that only one particular pair, which is the yen, that is weakening against the dollar very significantly. The rest of the pair is not showing very clear signs of weakening against the dollar. Okay, so now with that, right, so let us now take a look at the FX market first, the euro dollar. So euro dollar, very interestingly, yesterday, yes, it broke below 108.50 and hit the next support level, which is the 20-day moving average, not 20-day, the 50-day and the most important, the 200-day moving average, right, at 1.0840 before shipping that swift bounce up over here. Then upon shipping the swift bounce up, right, if we look at it over here, right, the price action here shipping lower low, right, okay, but the RSI starts to very clearly shape a bullish divergence. Okay, so with that, right, this continue of that positive element, I'll be using 1.0840 as a short-term pivotal support level, but it got to break above the first resistance at 1.0870 to have a much more increased probability of this potential short-term recovery in the euro dollar, for the next resistance to come in at 1.0910 thereafter. Okay, that's for the short-term intraday outlook. However, if we start to see a breakdown below 1.0840, will expose the next near-term support level at 1.08 figure level. this level here, 1.08 figure, which is the swing low of 28th of February and 1st of March. And if you do that PBoC retracement of that previous entire up move from 14 minor up move, I would say from 14th of February all the way up to the high of 8th of March, that confluence with the golden ratio at 61.8% at 1.080. Okay, so after 1.080, the next support level to watch will be at the 76.4% retracement, which also confluence with the previous minor swing low of 19th of Feb and 20th of Feb at 1.076. Okay. Okay, so that's for the key levels to watch on the euro dollar. So on the sterling dollar, it's much more better in terms of the technical outlook, because it's still trading way above the 200-day moving average, way above it. So where it actually bounced off yesterday, right, that short bounce off actually took shape right at this minor ascending trend lines support level that I drew from the low of 14th of February. Okay, so with that, right, I'll be using this 1.2670, which is this level here, as my short-term pivotal support level at this point in time, still maintaining that short-term potential recovery scenario, since it's managed to surpass back above 127 figure level yesterday. So this level here, so potential yesterday, this fake move might be a failure bearish bear trap, we call it a bear trap. Okay, after the recovery of 1.27 and managed to survive 1.2670. So first resistance to watch will be at 1.2760. So this level got to break out to the upside to actually increase the probability of that short-term recovery scenario, with potentially the next resistance coming in at 1.2820 level. All right, so now let us move on to the dollar yen. So before that, let me expand my screen. So that you guys could see. Okay, so let us start with the dollar yen. Look at the dollar yen. Okay, so dollar yen, right, given yesterday's strong move, right, so it's good to take a step back and look at the longer term chart of the dollar yen. Okay, so this dollar yen over here. Okay, so what we could see now, right, is now inside this major resistance zone of 150.20/1595. Why major? Tested one time, two time, three time, and most importantly, there was actually a real intervention on 21st of October by MOF. MOF is the Ministry of Finance, instructing BOJ to actually sell dollar buy yen. So that actually kickstart this sell off in the dollar yen. And right now we are back to this region again, where previously MOF actually intervened as well. So far, right, what you could see is that market MOF itself official is not speaking very much. Okay, so perhaps they are just playing a game with the speculators, but we know that it's coming very close to the 151.95 level. So from a technical analysis perspective, we know that it's bullish. Yes, their price action, but we got to respect the 151.95 level. Unless this level break out, right, then we could see higher high. All right. So if you were to take things at a shorter term perspective, right? So what we could do is that, yes, we could still remain bullish over here, given the fact that, yes, RSI is overbought, but there is no signs of a bullish bearish divergence on the hourly RSI. So I need to have a very tight short-term pivotal support level. I cannot use the 20-day moving average, which is 149.50. I will use yesterday's congestion level over here. That means this former lower high that has been pierced up yesterday. Then thereafter, the price action going to inch higher and higher after that initial pullback during the start of the US session. So this level here, 150.55. So 150.55 as my short-term pivotal support level, looking for a potential retest at the major resistance level of 151.95 in the first step first. Whether this level will break, will not know. Okay, unless it breaks, then the next level, 152.80. So how do I get this 152.80, right? And this 151.95, why is it important? Important because of that graphical resistance that I show you on the daily chart, and the way how the authorities behave at this level previously due to a real intervention in October, okay, in 2 years ago. So now, if you look at the current price structure as well, the current price structure as in from the current up mover for 11th of March, PBoC extension level also correspond to this 151.95 level. Okay, so if I take it from a PBoC extension, okay, 2.618. And if you look at from the, okay, give me a minute. Take it from here. Okay, project from here. Below 1.618 and 2 times, which gives me the 52.8 level, 52.8. Okay, 52.8. And if we go down to the lower intermediate wave, one time close to 51.95 and 1.382. Okay, so this is how I derive the 50 after 51 point. How I derive why 51.95 is important based on the current price action. PBoC extension clustering at 1591, and after 1591 it give me a lower level at 152.80 based on also the PBoC extension clustering technique that I shared with you. Okay, so if 150.55 tighten key short-term pivotal support doesn't hold, it breaks down. That means sometimes it may not hit exactly this level, very close to level, and it start to break down very fast due to potential verbal intervention or whatso from some of the MOF, which they like to do it any now and then. So the next support level to watch will be at 150.10, followed by the 20-day moving average at 149.50. Right, so this is the key levels to look out for on the dollar yen. Now, Aussie dollar. So Aussie dollar yesterday, it hit the support level after breaking down the 65.50 level. It broke down, and upon hitting the support level right at 65.20 and 64.90, very close to it, it shaped a V-shaped recovery. Yeah. So after this V-shaped recovery is shaped, right, the way the price move over here as well, lower low, you see the RSI also shaping similar lower, so a bit of bullish divergence as well. Then after also recapturing back the 65.20 level. Okay, so this could be what I call a washout move, a washout move. So given this washout move, where it stopped, right, it stopped right at 64.90 support level, and it also stopped at the ascending, this minor ascending channel that I drew from the low of 14th of February. So given this positive element, I'll be using 64.90 as a short-term pivotal support, looking out for a potential short-term recovery scenario again for the Aussie dollar, bias for the Aussie dollar. But for sure, it got to break up above 65.50 to increase this probability. Very important level. Why? This was a former minor congestion area, turns into a pullback resistance level, also confluence with the 20, 200 and the 50-day moving average acting as a resistance level at 65.50 as well. A clearance above 65.50 will increase the probability of that potential short-term recovery scenario. Next resistance that may come in will be at the 66 figure level. Only an hourly close below 64.90 will invalidate this short-term recovery scenario to see the extension of this corrective decline to retest the 14th of February 2024 minus swing low area at 64.40 level. Okay, so that's for the Aussie dollar outlook. All right. Now, benchmark stock indices. So benchmark stock indices, today, let's start with the Nikkei 225. So Nikkei 225, the Japan stock market, Japan 225, pierced above 39.84 level. So we got to be bullish again. So for sure, price action right now has started to transverse to the impulsive move. So whatever minor corrective, decline has been invalidated. So previously, we are looking for a kind of a retest at this 38.930, then followed by 38.360. All this has been kind of invalidated given the strong move that we see yesterday. So we've got to respect this move. And bear in mind, Japan stock market today is actually close. So what we are seeing right now is actually the futures market that is trading on Globex. So that's why in our platform, we still see live action as well on the Japan 225, which is tracking the Globex futures market, given the fact that the cash market is closed today for a public holiday. So I do not use the 38.940. This level is a bit tight, so I'll use slightly lower at 39.450 as my short-term pivotal support level. So any potential pullback, as long as it didn't break below 39,450, we will actually flip to a short-term bullish bias to see the start of a brand new impulsive up move for the Japan 225. First resistance to watch will be currently at the current all-time high area at 40,490/40,690. Above it exposes the next resistance at 41,475, 41,660. Only an hourly close below 39,450 will invalidate this impulsive up move to see another round of choppy minor corrective movement. So this more like a range resistance really, back towards the lower limit of this potential range if 39,450 takes out. Next support level 38,930 followed by 38,360, which is also close to the upward sloping 50-day moving average as well. All right, so that's for the Nikkei 225 or Japan 225. Hang Seng Index, okay, no change, continue to bounce over here. So what I could see now very clearly, there's a bullish divergence that's being formed on the hourly RSI. So Hong Kong 33 retested the 16,480 before shipping that recovery right now at this point in time. I show my screen. So this is indeed a clear pivotal support level that the bulls got to hold. for a potential short-term recovery to take shape back again on the Hong Kong 33 index within this short-term counter trend rebound scenario. First resistance it got to surpass will be at 16,890. Then thereafter it may expose the minor swing high area of 13th of March at 17,230. Only an hourly close below 16,480 invalidate this potential short-term recovery scenario to expose the next near-term support level at 16,135. Below it exposes 15,730. Okay, so that's for the Hong Kong 33. German 30 going to remains very bullish dynamic, higher high, higher low within this short-term ascending trend line that I drew, ascending channel that I drew from 14th of February. So no change. Yeah, we could have a first support level at this level here. Okay, somewhere around this level at 17,990, but it's a bit tight. So that's yesterday's minor swing low to use as a short-term pivotal support. So I'll still use 17,900 as long as any potential minor pullback managed to hold at the 17,900 short-term pivotal support. First resistance 18,100 followed by 18,190. Only an hourly close below 17,900 will see the extension of that minor corrective pullback to expose the next support level at 17,790, which now confluence with the upward sloping 20-day moving average, also acting as a similar support level as well. Below 17,790 exposes the minor swing low area of 5th of March to 7th of March, acting as a next support at 17,650. So that's for the German 30. Yesterday on the US Wall Street 30, we were neutral. So it broke above the upper neutrality limit at 39,100 level, a strong push up over here. So yes, we may see the hourly RSI at the overbought level, but there's no clear bearish divergence as price continue to go higher high. Okay, so there may be a bit of pullback taking shape. So as long as so given that it already broke out above the upper limit of that neutrality range, so we got to have a much more slightly bullish bias on the US Wall Street 30, because given the break of that 39,100 level. So in any form of a potential pullback that may happen because of the overbought condition in the hourly RSI, but without any bullish divergence, so without any bearish divergence, pardon me. So we'll be using the 20-day MA over here, also conferencing with this congestion area here, now turns into a pullback support at 38,930. So as long as any potential pullback managed to hold at 38,930, we'll be having that short-term bullish bias back again on the US Wall Street 30. First resistance to watch 39,270, followed by 39,400. Only an hourly close below 38,930 will revert back to another form of choppy corrective decline move to retest the previous near swing low area of 12th of March and 15th of March, acting as a support at 38,660. Below it exposes the next support level at 38,380 slash, okay, I'll use this okay, over here, slash 38,450 slash 38,380, which is so confluence with the upward sloping 50-day moving average. Okay, the one that's still weak will be the Nasdaq 100. So Nasdaq 100 going to trade within this choppy descending channel that I drew from its all-time high area at 8th of March. Okay, so yesterday's price action will be, yesterday we were bearish below 18,110, almost hit the first support level at 17,810 before recovering in the US session. All right, before recovering again. So for sure, 18,110 level will be the short-term pivotal resistance to watch. Still looking for a kind of a mild bearish bias to retest 17,810 level, potentially this level here. Only this level got to break right to expose the next support at 17,650, or else it will remain choppier within these two levels over here at this point in time. So first support 17,810, breakdown exposes 17,650, which is also confluence with the upward sloping 50-day moving average, as well as the lower boundary of this minor descending channel that I drew from its all-time high from 8th of March. All right, a breakout above 18,110 level means potentially we could have a hourly close above this level, will invalidate this short-term bearish tone, short-term bearish tone, to see another round of potential push up to retest the current all-time high area at 18,335, followed by the next resistance at 18,435 slash 18,470. So these are the two key levels to watch out for if 18,110 is cleared on the upside. Okay, so that's for the next. So what we could see over here is a pretty mixed bag picture. If you look at the entire globe, on the major benchmark indices, but it's much more bullish than bearish. The only one that is still having not clear signs of bullishness is the Nasdaq 100, which is important. Why? Because the Nasdaq 100 is leading the fort globally due to the AI optimism that is centered on NVIDIA. Okay, something to look out for. These are the key levels. So let us kickstart off with lastly with WTI crude oil. So WTI crude oil continue to remain positive. When you look at the daily chart over here, coming very close to the next resistance zone at 84.90 level that we have. So what's 84.90? Congestion area and the 61.8% PBoC retracement of the previous medium-term decline from 28th of September all the way to 31st of December. But overall, if you look at the bigger picture, it seems to us to be trading like a double bottom formation with the key neckline resistance at 93.80. Okay, so that's for the longer term picture. So on the shorter term, right, we'll be using given that it starts to play around the 83.20 level, so I'll be using a slightly tightened key short-term pivotal support level, which is Monday's swing low area 81.40. So as long as any potential pullback managed to hold at 81.40 short-term pivotal support level, first resistance 83.20 followed by 84.90, which is also correspond now to the upper limit of the short-term ascending channel that I drew from the low of 5th of February. Okay, hourly close below 81.40 will negate the short-term bullish tone to see the extension of the minor corrective pullback to expose the next support level 80.60 followed by 78.80, which is also confluence with the upward sloping 20-day moving average and as well as the long-term 200-day moving average and the lower boundary of this minor ascending channel that I drew from the low of 5th of February. All right, so net still maintaining the short-term bullish bias on West Texas crude oil with a tightened key short-term pivotal support at 81.40. Lastly, spot gold. So spot gold XAU/USD continue to trade below this minor descending trend line that I drew from its all-time high previously at this level of 21.95. all right, going to trace up lower high. All right, so what we use that no change, right, we'll be using 21.80 level as my short-term pivotal resistance potentially for that unfolding minor corrective decline or pullback to play out to expose the next support level at 21.25 and 21.10, which is so confluence with the upward sloping moving average. So upon hitting this level, potentially, right, the gold price could actually revert back to its impulsive up move. So right now what I could see is something like a retracement of that previous steep rally from the low of 23rd of February after that previous bullish breakout. So if you do the PBoC retracement from the low of February all the way up to the all-time high, this 21.25 actually and 21.10 confluence with the 38% and the 50% PBoC retracement. Right, only hourly close above 21.80 will negate this minor corrective pullback view on spot gold XAU/USD to see the continuous of the impulsive up move to expose the next resistance level at 2,200/2,210. Then above it sees 2,220/2,230. All right, so that's pretty much sum up for today's daily dose of market insights. So a bit more today. Why? Because there's much more ground to cover from the fundamental side of the story. So I hope that you guys have a clearer picture of what has taken shape or what has transpired in the market so far. So with that, have a good day ahead and we shall speak again tomorrow. Thank you.